Welcome everyone to Ledgerly's 5 strategies to implement before the end of the tax year in order to get benefit on our 2025 tax return, right? What can we implement before the end of the year to have an impact still on our 2025 tax return? This is going to be a top 5 playlist, but today, number 1, we're talking about funding your retirement. Now, we have our own framework of the accounts we like to prioritize first. And unfortunately, a lot of people will get this piece wrong. So that's why we wanted to record this video. We've talked about it in prior videos, but just picking this one piece out and focusing in on it in detail. We're going to go over contribution limits, deadlines, and maybe some nuances that you should think about before you go ahead and make your plan or actually make those contributions to these accounts. So we can get either the biggest tax savings, set ourselves up for the most tax-free growth in the future, and hopefully get an entirely tax-free retirement. But before we get to the whiteboard, just a quick introduction. My name is Andrew D'Amico. I'm a CPA partner here at Ledgerly alongside my partner in crime, Mike Abrahamian, who is also a CPA. We're CPAs who specialize in tax planning for self-employed individuals, where we focus on tax saving strategies, asset protection, your entity structure, as well as helping you guys build a foundation for generational wealth. So if any of those things speak volumes to you, please subscribe to this channel, give us a like, leave some of your comments, your questions. We'd love to get back to you, interact with you, and hopefully work with you in the future. But enough discourse. I want to get right to the board here. So the problem that we're covering today is the funding order for our retirement accounts, because there's a number of retirement accounts out there. A lot of people will get this order wrong. They may assume the deadlines for funding these contributions are incorrect. They miss deadlines and they don't think about the old question, hey, traditional or Roth, which one is going to be best for me in my situation? So let's get into it, our framework. So right on my board, you can see I kind of built a pyramid almost, building blocks, because we want to make sure that we have a good base and then we work up from there. So really, this is working bottom to top in the accounts that we want to fund first. So number 1, especially if, yeah, you might be self-employed, but you might also still have a day job, or you might have a spouse in the picture who does have a day job where they are participating in a 401k plan. So number 1 down at the bottom is we want to go out and we want to fund our 401ks. Now, the employee contribution, you can see, put it up there for you. The EE, if my marker would work, limit in 2025 is $23,000. Sorry, $23,500. If I could write a dollar sign. Now, that is how much you could put in as the employee. But as you may know, the employer will typically offer a match, whether it's 3%, 4%, 5%, 6%, whatever your employer offers. I don't want you to put in 23.5 because your employer is probably not going to match up to that much in contributions. They're going to say, we will match up to 6% of your wages in your contributions. So, quick example, if you have a $100,000 W-2, your employer offers a 5% match. You can fund $23,500, but they will only match up to that first 5%, so up to the first $5,000. But that's powerful because, hey, that's 100% return on our money. I can put in $5,000 and I'm going to get another $5,000 from my employer. So it's very powerful. So that's where we want to start. So we start with, I'll say, man, this marker sucks. Let's say day job 401ks. We know that is our limit. We want to match and out. So I am not saying fund 23.5. I'm saying, hey, whatever the match is, 3, 4, 5, 6%, let's fund so we can get that 100% match from our employer. And let's go ahead and let's do that thing first. That is number 1 on our list. After we take care of that day job, then what is the next vehicle we want to get into? I want to get into our IRAs, right? This could be traditional, this could be Roth. Man, I am really struggling with the markers here. We're just going to go blue. Apologize. IRA. And if we are under the age of 50, that contribution limit is going to be $7,000, or it could be $8,000 if you are over 50. Say over 50. That's the next piece of the pie, the next piece of the puzzle. And depending on your income limit, you might be thinking, hey, I make too much money, I can't contribute. No. Don't get caught up in IRS lingo or what other people might tell you, because they might be uninformed themselves. You can absolutely contribute to an IRA account. It's just going to factor in on your AGI if it's deductible or not. Let's say you're over the income threshold. You may not get that deduction if it's traditional, but you could make a non-deductible IRA contribution to the account nonetheless. And if you're over that limit and you want to get into Roth, you start there. You go with your traditional IRA, you make a non-deductible contribution, and then on day 2, you convert it over to a Roth IRA. You roll it over to a separate account. So you can still get your monies into Roth for that long-term tax-free retirement. You just got to be a little creative and have the know-how to do this. But everybody can absolutely do this. Don't let anybody tell you otherwise. That's the next step in this equation. We get our 100% match at the 401k. Then we go to our IRA. And again, this is an individual retirement account. So if you have a spouse in the picture, you yourself can have an IRA and then your spouse can have an IRA. So let's take care of both of our day job 401ks if we have it. And number two, let's fund your IRA and let's fund our spouse's IRA. And you can see I've drawn up the income tax brackets, the rates. I didn't go through the brackets because I didn't want to draw up the brackets for single, for married filing separate, for married filing joint, head of household, right? Because all those income limits are different. But these are the tax rates. So if you're familiar with the Roth chunking strategy, hey, I'm going to take a piece of traditional monies, roll it over to Roth. Yes, you have to pick up that income in the year you convert it to Roth because you got a deduction on the way in. Now we're going to convert it. So now you kind of have to pick up that income again. So this is why we want to look at this at year end, especially because, hey, where are we sitting in terms of these? That is a terrible line, but you know what I mean. Where is our income going to fall? What tax bracket are we going to be in? Because we want to avoid, if we're going to chunk, we want to avoid pushing ourselves into the next tax bracket. So you can see there's a jump from the 12% tax bracket to the 22% tax bracket. That's a 10% increase. So if you rolled over $7,000, let's make it easy. You funded $10,000, you rolled from traditional to Roth, that's another $10,000 of income. If that $10,000 is going to put you into the next bracket, that's going to get taxed at 22% as opposed to 12%. Hey, maybe we don't want to do that and pay an extra 10%. Or another big jump is the 24 to 32. But if we're going to chunk from, and it's going to push us from the 10% bracket to the 12% bracket, that's only 2% increase. Maybe that's strategic for you. You can afford that. Cool. Let's take it in those, I don't want to say low income years, but you know what I mean? When we have the opportunity, maybe business has a down year, or you're just getting off the ground, you just quit your job, so you have less income. Those are the years you want to look at in terms of chunking. But chunking is a different topic entirely. Don't want to go too in depth on that, but that's just a little nuance and something to look at during year end. After we fund our IRA, next I want to get into is the HSA, the health savings account. And there could be some argument, maybe you go HSA before the IRA, but single plan is about $4,300 and a family plan, the contribution limit is $8,550, and that's for 2025. And the HSA serves as a triple threat because you get a deduction for your contributions on the way in. It's a savings account. It can be invested. Those earnings are going to grow tax-free. That's the second benefit. And then third benefit, it comes out tax-free for qualifying medical. So the HSA is very powerful and it's third on our hierarchy. Once you've taken care of these first three steps, especially for our business owner clients, then we want to talk about, hey, what about a solo 401k? Now, the reason we put this up here is if you've heard us talk about self-directing, hey, listen, if you're the solopreneur and you can set up this plan to ultimately that's going to benefit you and your family, hey, you put your spouse on payroll, they could play in the 401k, your solo 401k. If you set it up, you could self-direct it to potentially get higher returns. You can invest in real estate, in cryptocurrency, in these alternative creative assets, so to say. Whereas at your day job, you're not going to have that freedom. So that's why we put it up here. Again, our employee contribution limit is $23,500. But please note that it's not $23,500 in this plan and then another $23,500. It's across all your 401ks. So if you funded, let's say $5,000 in here, you can only put in as the employee $18,500 up there. And the max limit for 2025, your employer, or if you were going to utilize the after-tax account, you could put away up to $70,000 in a given year. Yes, there is a catch-up provision if you're over 75. Sorry, not over 75. If you're over 50, I'm kind of running out of room, but just know that that's out there if you're over 50 as well. This is the absolute limit for the amount that can go in. So if you do the math, the employer piece combined with the after tax, that can give you $46,500 combined with your employee of $23,500. I mean, there's a few ways you can go about it, but just know that this is the absolute max that can go into a 401k in a given year. Now, I've also drawn up over here important dates. I talked about, hey, when do these monies need to go in? Does it have to be done by 12/31? Not necessarily, and I think that's where a lot of people get confused. So important dates, 12/31 and 1/31. 12/31 obviously being the end of the year. But January 31st, why is that date important? That's when all W-2s, all tax forms from employers are due. And whether you're down here or up here in the solo for those employer sponsored plans, the 401k contributions, deferrals, they have to be stated on your W-2. So although you're not filing a tax return until one of these dates, they need to be stated on your W-2, which is due up here. So even if you don't even if you don't move the money by this date or 12/31, you need to know what you're going to put in there. You could actually move the money up until these deadlines when you file the tax return. That's the absolute date they're due. So I'm not going to itemize by account type, but as far as moving monies, all of these accounts, the money needs to be moved by the time you file a tax return. So for the employer pieces, that's going to be on the business tax filing deadlines, right? If you have a pass through, like a partnership or an S corporation, that's going to be 3/15. I'll just simplify it. I'll say biz returns are due. Again, running out of room. I hope you could follow along. April 15th, I'm sure you're all too familiar, is 1040s or your individual returns are due. And then 9/15, 10/15, why do I put those in there? Well, if you're familiar or if you've gone on extension for 6 months, then you actually don't have to abide by these deadlines. Then you can go to the September or October. So September is when business extensions are due, and then 10/15 is the individual to 1040 extensions. So you could potentially have 9 months to make some more money, set some more money aside, and then actually move those monies into the 401k, into the IRA, into the HSA. So it's an incredibly powerful little bit of information to know, because maybe you're like a lot of people, you're getting caught up in the holidays. You need to obviously allocate some spending for that. Of course, if you love your friends and family and you want to give them some nice gifts. So maybe a little strapped for cash near the end of the year. Maybe depending, your business is seasonal and you're like us, you make a killing in the tax season, because that's whenever obviously everybody's focusing on their taxes. That's when a lot of people reach out to us for services. Maybe you're a service-based business that crushes the summer. If you go on extension, then you have obviously that opportunity, another 9 months to get some monies, keep on hand in the business, and then fund the retirement later in the year, but before you file your tax. So again, this was just number 1 on our top 5 strategies for year end, is just funding your retirement. Connect with a CPA, a tax advisor, run your year-end projections. How much money have you made in the business, your spouse, any other income activities, whether operational or passive, and let's get a projection of kind of what income tax bracket we're in. Hey, does it make sense to do traditional this year so we can get a deduction? Maybe we're in one of these higher brackets. Is this a good year to chunk? And start to get that plan in place of, okay, how much can I reasonably put away here? Can I get into the IRAs? Can I get into my HSA? And then ultimately the creme de la creme, the solo 401k. And again, that last piece isn't going to apply to everybody. So that's also why we put it, number 4 on our list. But if you want to personalize a year-end plan for your retirement accounts among a myriad of other things, please get in touch with us. Go over to our page, our YouTube page. We got links to our website, our calendar, book a call with us. There's still time in the end of the year to get our retirement plan in place and take advantage and get some benefits for 2025, or again, plan for that tax-free retirement. Appreciate you listening in. Please leave your comments, questions, like, subscribe to this channel, and we'll see you guys on the next video.